On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
24 to 5 now. Luke Smith, I think that's your cue to tell us some of your financial wisdom.
Well, it's stopped raining. That's a good start. Far out. Well, we've had some Melbourne weather today, haven't we?
We've had a little bit of everything. That's right. Yeah,
it was chucking it down at the kids' swimming carnival today, and all of a sudden jumpers are coming off. It was hot.
The only thing missing is the snow. We haven't had any snow.
Exactly. Luckily, it didn't get down that cold, but yeah.
No, it's been quite warm, really.
Yeah, it is.
Quite warm, really. Today's topic is, do I have to take a full pension from the PSS when I retire?
Yeah.
Now, I know that the PSS is something to do with the public service, right?
Yeah, look, good guess. This is quite topical at the moment, and I don't know why. It must have just been sort of the last 2 weeks I've had a number of people in chatting about this, and I thought it was just a good opportunity to try and clarify or knock over some misconceptions, because people in this fund are leaving huge opportunities on the table on a number of fronts. But if we can sort of separate out what you can do against what you should do, and what we're going to touch on today are options. I'm not saying do it, but I want you to understand the variances that are available, because the fund does a really, really poor job of explaining that when you reach out to them and ask for information as you approach retirement. So anybody in this fund might say, okay, I'm going to leave on the 1st of July, I'm going to retire, great. And inside 12 months of their exit date, you can contact the fund and say, okay, I'm going to leave on the 1st of July. Can you calculate my estimates, please? Because it's a defined benefit scheme. There's a specific formula that's used, and the fund spits you out an estimate, and it's right down to the cent. It gives you taxable, tax-free, and all of the data that you need to make an informed decision. Now, the greatest misconception with this fund, there's two sides to it. One is, I've got to take a full pension. You don't. The other one is that I have to take half of my benefit as a pension. You don't. The rules of this fund say that if you choose to take an income stream, you must convert at least 50% of your benefit as a pension. Now, with the way this fund works, they take your final average salary, they multiply it by the contributions that you've accumulated over your working life, called your accrued benefit multiple, and that creates a number. Call it $1 million. And then depending on the age that you go, from 55 onwards, there is a specific number or factor for your age. And you divide the number that's created by the formula by the factor for your age. And if you take a full pension, that number is how you work out what your income stream would be for the rest of your natural life, right? Wonderfully generous fund, wonderfully generous factors, and the income value of the PSS is second to none. I'd say almost globally, right? It's that generous. But nothing frustrates me more when people walk in and go, I have to do that. And I throw a proposition up and say, why don't you take 73% of it as a pension and the rest as a lump sum to buy that, or pay off this and this, or to manage the estate planning for your children with this and this. And the look of bewilderment that comes across someone's face and said, but the statement from the fund said I can have that or that. No. You must take at least 50% of your benefit as a pension. At least. 54, 97, 62, 81, 76, whatever suits your situation and your planning, you can go to the fund and say, hey, thanks for the generic estimate. Can I now have 64% of my benefit as a pension and the rest as a lump sum, please? Give me those figures. And I want people to interrogate the numbers, because once you make a decision with this fund, there's no take-backsies, all right? That's you for life. You can't commute it. You can't cash it out. You can't do anything but the decision that you make. And it's a massive decision for people that have been in a fund potentially 20, 30, 35 years. So don't assume it has to be half. Don't assume it has to be 100. It can be anything from 50 to 100, all right? Ask them. They won't offer that to you. You need to call them up and say, hey, thanks for my generic option. Can I have a pension estimate, please, with 82% as a pension, 64% as a pension, and whatever you want to see a number of, so you can do some comparisons and get the outcome that is right for your specific situation. And if you've got both of you in that fund, and I had a few of that this week, why don't you take half and use half for this purpose, and then you go full pension so that we've got a guaranteed income stream of X, and you start to then mix and match the objectives that you have with the access options that are available through the fund. But don't leap out and take the generic option by default, thinking that you have to. Okay, it makes no sense.
So, long story short, you can take anywhere from 50% all the way up to 100% as a pension. Now, what that implies, of course, is that you can take anything from 0 up to 50% as a lump sum.
Correct. That's exactly right. Now, another thing you need to keep in mind, this fund operates under a different preservation rule to the rest of the superannuation world. So you've got to be 60 to take your super in a normal super fund, in a standard accumulation fund. This fund, you can take it from 55 onwards if you cease work. Now, let's say you go down the full pension option at 55. Great, here's your income stream. You have 6 months off. You go, wow, I'm bored. And for my own mental health, I think I'll go back and do something else. The definition of retirement from 55 to 60 says you've ceased gainful employment and you do not intend to work more than 10 hours a week ever again. Intend. Doesn't say must, mustn't, can't, shouldn't. It says intend. Now, intentions change. So as long as your intentions look and quack and waddle like a duck, nobody can ever say they're a lion.
Mm-hmm.
All right? So you can take your pension at 55, have a break, get another job, go back and do something. People then come in and go, oh, but what about the tax? What about this? Oh my God. All that happens is they take the components of your pension, and the tax on your PSS pension from 55 to 60 is impacted by your years of contribution, the type of contributions that are in your fund, and ComSuper, who provide the pension, they give you all of that information. And all that happens at the end of the year is your accountant says, you got that from the PSS and you went and earned this. You come down and go, what's in the income bucket? What's the tax that I pay on it? I've had 3 people come in this week and go, well, if I go back to work, I pay 49 cents in the dollar on anything that I earn. No. So don't limit your capacity to do something else that you might want to do by using or assuming a false assumption that you're going to pay top marginal rate on anything that you earn, because all that happens is they go, what's the taxable component of the pension? What's the tax I've earned on another job? And then you might say, oh, I'll go and make another contribution to super to lower my tax. So don't be limited by the perception of top marginal tax rate, because it may not apply to you. Also, don't assume that because you're in the PSS, you can't add to another fund. I've had this one 3 times this week as well. Well, I put a 10% contribution into the PSS, that's all I can do. No, it's not. That's all you can do as a maximum into that fund. But on page 5 of your annual statement, the fund tells you how much room you have in your concessional contribution cap of $30,000. And on page 5 of a PSS statement, they say, we've assigned this much, let's call it $15,000, of the employer part of your fund to the $30,000 cap. That means you could put $15,000 and claim 100% of it as a tax deduction into another fund, because the structure of the PSS does not allow a personal contribution of that nature. Nothing says you can't have another fund. So don't leave great tax opportunities or tax saving opportunities on the table because you assume that you can't do any more when you can. Because if I gave you a choice and said, do nothing and pay 39% tax on your wages, or put $15,000 into super and pay 15% tax, that is delicious. So you need to investigate it. So let's not assume that the chat around the water cooler is, oh, you can't do that because Shirley said so. Well, let's find out, because the frustration I have is people come in, okay, I'm going to go in 6 months. Have you been doing that? Can I do that? That is frustrating for me, and that's why we're talking about it, because I'm just trying to demystify some of the PSS assumptions that I come across, because people are leaving great opportunities on the table. I would also say this as a generality. If you are in that fund, do everything you can physically do financially to get your contribution to as close to 10% as fast as humanly possible. Because the one thing the PSS does not help you with is time. With a normal super fund, you might have other priorities and say, well, I'll catch it up later and put bigger contributions in. You can't with the PSS. The max you can do is 10. You can't catch up retrospectively. And your final entitlements are a direct result of your accumulated contributions. So I never say must, and no one will ever hold me to this, but you must get as close to 10% as you can afford. And I would, if you were in this fund and plan on staying in the fund for a long time, I would do that as a priority over just about any other financial decision, because of the wonderful generosity of this scheme and the value of the income that you can get from a much smaller amount of capital compared to a normal super fund. And it kills me to see people come in who have been in the fund. I had this 2 weeks ago, 25 years of service, hasn't been making a 10% contribution because nobody explained it. You can't go back and fix that. And that is such a massive financial detriment. People need to know, and people need to not assume and use the rules of this fund and its generosity to the maximum of your capacity.
So there's a lot to take in. It's around about 13 to 5 now on 2CC. Luke Smith from Envision Financial is with me in the studio today. We're talking about whether or not you need to take a full pension from the PSS when you retire. The answer is no, you don't necessarily need to. No. You may wish to, but you might wish to make a different arrangement.
Spot on.
We'll be back with more very shortly. Eight minutes to 5 now. It's a Friday afternoon, and that means Luke Smith from Envision Financial is with me in the studio. And today we're talking about whether or not you'd like to take a full pension from the PSS when you retire. And you've started off from the point that most people assume you either have to take half of it as a full pension or the whole lot as a full pension. Correct. And they don't always realise that you can actually take anywhere in between.
Exactly right. And I guess that's what I just want people to take from today is think about what you're trying to achieve, whether you've got yourself and a spouse in it, or one in, one isn't. There are a number of benefits to this fund, and the calculation of the income stream is extremely generous. So in a lot of instances, taking the full pension is a way to maximise the value of it. But like anything in life, nothing is a silver bullet to fixing all your problems, because if you don't have a spouse, then you pass away potentially, depending on how long you receive your pension. There could be no money that you could transfer to your children. So whilst it's a great income stream, it could have limited estate planning control. So you want to think about, well, do I take part? Does my spouse have one? Does he go full? Does she go full? Does he go half? Does she go half? And you try and structure all of the wins that you try and have when it comes to deciding how we're going to fund our life and how do we control the transfer of our wealth to the next generation. Because the problem with the defined benefit scheme is you can't cash it out. Now, a spouse receive 67% of an income stream for the rest of their life, and that's wonderful. But on the passing of that individual, the income dies with the second spouse in the majority of instances. So from an estate perspective, it's actually quite a difficult fund to deal with because you've got limited control. So you've got to sort of weigh up, well, what other assets do I have outside of super? Have I got houses? Have I got a trust? Have I got a normal super fund? Et cetera, et cetera. So, don't just assume it's 50% or 100%. It could be anything you want it to be, but then try and blend that together. If you're both in there, get the best outcome possible. Try and get your salary as high as you can, because your final average salary in the last 3 years is a key contributor to the formula and the outcome of your benefits. Remember that you can put money into another fund and claim a tax deduction in addition to your 10% or any percentage that you're putting in. And I strongly advise people to look at their statement. Page 5 gives you, in the table on the bottom of page 5, it says what has been recorded against your concession or contribution cap. It's the second column or second row in the table. It gives you that number. So think about your situation and think about making a personal deductible contribution or salary sacrificing, which we've touched on in many a show in the past, so that you can manage your income tax along your working journey whilst also maximising your entitlements. Try and stay in a job for more than 12 months, because that will give you an increased final average salary in a higher duties role where you've been in it for more than 12 months. Remember to consider using up accumulated leave when you're in the PSS, because if you stay in the fund, you're adding to that accrued benefit multiple, which then means you're giving every likelihood or every opportunity for your formula to be as attractive as possible, as opposed to cashing it out and not being in the fund. So think about using leave if you are a member of the fund, because it extends your membership and increases your accrued benefit multiple. And keep in mind that the tax on the benefit is impacted by the components of your membership. So don't assume that it's tax-free over 60, because it may not be. There are a number of tax concessions that occur after 60 that you do not get from 55 to 60. So the treatment from 55 to 60 is one stage of it. From 60 onwards, the tax treatment changes because you're entitled to a rebate. So think about what you need to live on. Think about where you'll source your income. And if taking part of the benefit as a lump sum to clear your mortgage, to clear some debts, to pay some HECS off, to set the kids up, don't be afraid to consider anything from 50 to 100 and ask for it in relation to the estimate, because they will do it for you. You can't ask them for a figure. They'll tell you they want direction. So you want to call up and say, hey, what would 75% of my benefit be as a pension? What would 82% be? What would 68% be? Ask them. They will produce it for you. They're very good at doing that, and that's their job. So have as much information as possible available to you. Also remember that you need to consider the implications of starting a pension from a transfer balance cap perspective. Because if you do have a large accumulated superannuation fund and you leave with a very big pension, you may be in excess of the transfer balance cap and unable to start a pension when you do retire. You might then look at a recontribution strategy to get money into a spouse's name so they could start a pension so that everything's tax-free. So there's a bit to the PSS. So have as much information as possible. Be as aware of your options as possible. Take advantage of the contribution at 10% as soon as you physically can. And I would say that to the detriment of just about anything else, because of the long-term security of the way that you can take your benefits.
So, Luke, where can listeners get more information?
Yeah, office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the Strategy Stacker podcast on iTunes and Spotify. And we've got the YouTube channel Envision Financial Canberra, where we've got a backlog of all of our shows that you can watch on your phone. And we've got Smart Money Strategy, your ultimate guide to financial planning, in all good and bad bookstores.
Sensational. Luke, you have a wonderful weekend, and we'll catch up with you again same time next Friday.
See you next week.
Luke Smith from Envision Financial back with us on 2CC next Friday afternoon, straight after the 4:30 news update.